podcast, an inside look at California politics and the state legislature. I'm your host, Assemblyman Josh Hoover, and I'm really excited to be joined today
Yes.
by Seren Taylor. He is the Vice President of the Personal Insurance Federation of California. Seren, welcome to the podcast.
Well, thank you. Thank you for having me.
Absolutely.
This is my first time on a podcast. This
Oh,
is new.
no way, really?
Yeah, oh yeah.
Well, this is also like episode 30 of this podcast, so
Okay.
this is like...
So you're like a seasoned
We,
pro. You've been
I
doing
wouldn't
this.
say I'm a pro, but we've definitely refined things over the last few
Joe
months.
Rogan, look out.
Exactly, right? But no, we're really excited to have you. And what we're going to do today, one of the reasons I wanted you to come on is really talk about stuff going on in the insurance industry this year specifically. Obviously, there's a lot going on.
There's stuff happening in insurance.
There is a lot going on with insurance. Last week, I think it was State Farm talked about like the 72,000 non-renewals, for example, right? Which is going to be a big topic of discussion in the legislature. So I want to definitely get your thoughts on that. But before we do that, do you want to just introduce yourself real quick, a little bit about your background?
Sure. So, well, currently I'm Vice President of the Personal Insurance Federation of California, as you noted. I've been there about 5 years. But prior to that, I did 21 years with the state, 5 years at the Department of Finance. Variety of assignments there. I was overseeing the budget for Department of Corrections and did a lot of the resources departments and agencies, what's now Fish and Wildlife, Tahoe Conservancy. So I had all these different policy areas that I was engaged in. And then came to the legislature. I spent, 16, 17 years in the legislature, Senate and Assembly, Budget Committee. Eventually became the fiscal director for the Senate Republican caucus.
I think that's when we met, or maybe a little before that. I don't remember.
Yes, you were with, then Senator Walters.
Yeah,
and she was my vice chair of appropriations, and she was great. She was a lot of fun to work with. I remember actually doing coffee talk with Mimi. Was the first time I had been on like a whole show.
That's hilarious.
Yeah,
I remember that. That's
so
funny.
we're full circle over here.
Yeah,
but so I did that for 10 years, and there, that was really interesting, fun, and exciting. And of course, that was when there still was 2/3 budget votes, and we'd have the budget dramas that would go on for months. And I'm sure people don't miss that. So anyway, I'd done that for 20 plus years before joining PIF about 5 years ago. So
that's great.
Just a long career public servant.
I love it.
Long career public servant.
Well, you know what? Like, I think, it's obviously we've known each other a while, and I've always appreciated your expertise on the budget. And we might even get into a little question about the budget here.
Yeah.
So we'll start off this week. So every week we've been doing this question of the week where we like throw up a Twitter poll or an X poll, whatever you want to call it.
Right.
Last week, the question was, should schools restrict cell phone use in the classroom or during the school day? The results of that one actually, so I have a bill on that this year, so I'm a little biased. My answer was yes, but it was about 80-20 yes.
Yeah.
At least from the experience I've had with my kids.
Right.
It's
same. I mean,
it's not good.
I'm hoping they're not over there playing games and Snapchatting their friends while they're in math class. So.
Exactly. It's very distracting. So that bill actually ended up passing unanimously out of education last week.
Oh, good.
So it requires school districts to pass a policy limiting the use.
Gotcha.
So.
I presume they still have in case there's an emergency.
Yes. But there's carve-outs for emergencies.
Right. But
like
you just shouldn't be hanging out in class on your phone, though. It doesn't seem like conducive to an educational environment. But.
Yeah, it's funny. I had a lot of bipartisan support, which was great. Got a little grilled by one person, but she came around.
Who shall remain nameless.
Yeah, she came around, and I appreciated her support. And so we're going to see how that goes on the floor.
Okay.
So
that's good.
But this week's question, there was a bill that got introduced by my colleague Matt Haney in the Assembly that essentially requires employers to allow their employees to disconnect from work. You probably saw this.
I saw it in the paper. Yeah, I haven't read the bill. But.
It's I'm gonna see if I can pull up the language here just to give a little context for this. Let's see. So essentially, let's see here. I'm gonna East Bay Times did a piece on this, but essentially it's kind of being called the ignore your boss bill, right?
Okay.
So after hours, when you're outside of work hours,
Right.
it would require employers to have a policy that allowed you to disconnect from your boss and not respond.
So if you're the OES director and the governor calls you because there's a fire heading over to Tahoe, you don't have to answer?
So the way it's worded, so there are 2 exemptions in the bill, right? One of them is for emergencies.
Okay.
So I don't know. I'm assuming that would qualify for an emergency. The other one is for scheduling. So poor schedulers, like they don't, anyone with a calendar doesn't get exempted or gets exempted apparently.
Well, again, in fairness, having not read the bill, and so I don't want to presume anything with Mr. Haney's bill. But the one thing, I saw the headline in the paper, and the thing that popped into my head, because I sit on the board of a nonprofit that serves adults with disabilities.
Yeah.
And so a lot of times, you have staffing issues, or someone can't make it. Someone need 24-hour care and that kind of thing. So you're always trying to call. You have to be able to call people.
Or
can someone come and cover this shift? Can someone come and do this? So that was the only thing that popped in my head when I just heard it. I was like, how do you meet organizational needs, or even if it's a donut shop and one of the bakers can't come in, you got to call the other guy and say, hey, can you come in tomorrow?
I was just going to say that because I worked in restaurants for years, right? And if someone calls out,
right,
you're calling them to give them an opportunity to make some money, right?
Right.
So it's like
right, or but just keep things functioning. So I don't know how the bill, I don't know enough about the bill to say if that's an issue or not an issue, but it was certainly the first thing that popped into my head.
I think all these are kind of questions that are going to be asked, right?
Right.
It's like,
Right. And then I get it. I presume, in fairness, there's an element of this now that we're so connected.
Yeah.
And certainly in our, obviously with you being an elected official, you have to always be responsive. And then similarly, for me, I find myself 9:30, 10 o'clock at night, 1 a.m, checking emails, texts.
Yep.
And, I understand people don't want to be living like that. And it's a unique aspect of our society today. So how do you find that right balance, which I'm sure is what he's trying to get at.
Yeah. Well, and that is really the one thing that I thought of was, before smartphones, right? Like you couldn't,
That's right.
call. Well, I guess you could call, but you couldn't text or email or
right.
Whatever. Like it would literally. It's like, oh well, Jimmy's gone for the day, so I guess we'll see him tomorrow, sort of thing, right?
Yeah.
And we weren't constantly connected, which I do think it's harmful to that work-life balance.
It
right?
is. I know it's really hard. And I remember, I remember saying in the early 2000s, I resisted that first. I had that BlackBerry. It wasn't, I think, until I became fiscal director.
Yeah.
Then I was like, all right, I guess I have to have one just for that reason. Because I was like, great, I don't want that. Then anyone can reach me.
Yeah, then you can bug me at any hour of the day. Like, come on.
But then I was glad. Then the other flip side of it was I was sort of glad was I realized I don't have to be in the office now to do an email. I don't have to.
True.
So it gave me flexibility because I had my first kid around that time.
That's a good point.
My daughter. And I was like, well, now at least I can answer emails from the soccer game or from here, and I don't. At least I'm here. I'm at the game, even if I'm a little distracted.
But you're not missing.
But
it,
I'm not
right?
missing it, right? So there is an
I
upside.
guess it does cut both ways.
Yeah, there's a benefit to it, but
That's
it
funny.
definitely. I get the tension.
Yeah.
I'm not sure how you can't walk back from technology though.
It's really hard.
It's here.
It's really hard. So the question this week for listeners is going to be, should the legislature give California employees a right to disconnect from work-related conversations during non-work hours? Or is this a boundary best handled between the employer and the employee? You can go to X. It's @PointOfOrderPod on Twitter, X. To vote on that poll. So we'll see what people think. I don't know.
I'll make sure to go put my vote in.
Yeah, go put your vote in. I don't know.
I'm not gonna let Rex know who's the president of PIF.
Yeah, exactly.
How I'm voting on the disconnect bill.
And the question too is, and I don't think Twitter reveals who votes, how they vote, right? But the other question obviously is, all of these things could be true. Is it the role of government to require that, right?
Right.
Versus should that just be, okay, this job is way too demanding, I'm gonna go find another job, right? What I mean? It's
or different organizations have different needs. Some things it might lend itself to that, or even some positions,
right?
But others may not. right?
So we'll see.
That's always the problem when you try to do, I think, statewide things, and you can't. It's hard to have it work for every situation.
Absolutely. So we're gonna jump into our stories of the week, and we'll kind of fly through these because I do want to get to the insurance stuff. One of the big things this week is CalChamber just released their big list of 9 job killers 2024. So essentially, California Chamber of Commerce every year has this very well-known list of priorities, right? Where
is that a record low? Only 9?
Only 9.
It seems small.
I felt like last time it was like 17 or something.
Yeah.
So maybe
that's good.
I don't know. I don't know if that's good or what. It sounds good to me. But yeah, 9 bills. Most of them dealing with, one of the big ones is obviously unemployment insurance benefits for striking workers. That was something that has been, I think, was vetoed last year actually by the governor.
Okay.
So that's on their priority list.
Yeah.
We're going to actually break this down more in a future week. So there's a number of bills. The other one, like single payer healthcare, this has been brought back again.
Yeah, it's been around for
this has been
decades.
put forward every year for a long time. That's on the list. And so we're going to break these down more in future weeks, but we will put the link to that list in the show notes if anyone wants to take a closer look at that. Another big announcement this week, the PUC came out with their kind of long-awaited fixed rate proposal. I don't know if you've kind of heard about this story.
I've been tracking it a little bit.
So the legislature passed a bill in 2021 in a budget trailer bill that required the PUC to create a fixed rate charge for investor-owned utilities. So most of the municipal utilities already have fixed rate charges, but this investor
seems like a very appropriate issue for a budget trailer bill.
Right. So this is what the big rub has been is just to set a little of the context. So like they passed this bill in a budget trailer bill. It was the second bullet point in the analysis on the first page.
Right.
And then a number of legislators are out this year trying to repeal that provision, saying like, well, we didn't really know what we were voting on. But again, this is why, and that's what I've been saying, this is why you don't do it in budget trailer bills.
Right.
Because that is a huge policy change that you want to have in a policy conversation, right? Like,
oh, yeah.
Well,
my history on that.
So I think that's, there is a group of legislators out that was trying to roll this back. Interestingly, the PUC's proposal, there was proposals on the table for $73 fixed charges.
Okay.
That was the top of the, which if you think about,
that was the income-based ones, right?
It was an income-based one. The fixed rate would be $73, and then obviously that would reduce your hourly usage rate or whatever proportionate. But like a $73 fixed rate is that's a lot of money, right? On a monthly bill. So what the PUC ended up coming out with was a $24 fixed rate, and then it would be $6 to $12 if you're on a care program or one of the low income programs.
Right.
And so certainly the proposal that came out of the PUC is a lot more reasonable than what some of the proposals that were on the table.
Right.
So we'll see how the legislature responds. I don't know if that group of legislators is going to continue forward with their bill or not. But essentially the proposed decision that they're going to be voting on May 9th is right around, they have a chart here. It's like, it's identical to the SMUD rate. So all of my constituents are on SMUD. I don't know where you live.
Yeah, I'm on SMUD. I'm downtown.
SMUD too.
Yeah.
So it's identical.
I'm very grateful to be on SMUD.
I am very grateful to be on SMUD. So it actually is identical to the SMUD rate. And then it actually brings down your hourly usage rate or your usage rate like 5 to 7 cents per kilowatt or whatever.
Is the idea that with that somehow, people across the state, like in San Diego, all the way, through the Bay Area, are going to see their bills look more like SMUD level bills? Because I know I have friends in other parts of the state who, when they tell me what they're paying for electricity, it's
crazy.
It's shocking. Yeah.
I mean, right outside my district, we've got, El Dorado County and Placer County, and it's just a totally different story.
Right.
I mean, the goal is, I think, to provide more stable funding for infrastructure for utilities. Right. But I don't really see it bringing down the rate that much, as a whole, because, at least not compared to what SMUD is charging, because there's a lot of other issues that those utilities are having too.
Right.
So,
obviously wildfire, one among them.
Yeah.
Yeah, it's hard. I don't know. It's
Which
not
bleeds
my-
into the insurance.
It's
thing, too,
I'm sure it's much more complicated. Yeah, that does. It's much more complicated than that. But yeah, I could see. I mean, the infrastructure is a big deal for them, and I know there's not PG&E doesn't have a lot of get a lot of sympathy from folks, but certainly when you have to run those lines,
I know.
throughout I don't know how many thousands of miles they have to run lines through forests, through
I
to
know,
all these
yeah.
tiny communities up in the in Northern California. I'm sure it's a complex situation with the infrastructure and how you fund it.
Yeah, it's crazy.
Versus being in SMUD being in a concentrated sort of urban area.
Right.
It's a lot easier how you deal with that. But
yeah, it's interesting. Like Roseville Electric, because they have all their own utilities out in Roseville, their own system. So they're at about a $30 fixed charge. So it's an interesting proposal. I think everyone's kind of digesting it right now, and we'll see what happens on May 9th. We are going to include in the show notes a link if you do want to give a public comment on it or something. That link will be in the show notes to the PUC. Did you hear about this? I'm going to skip down a little. Did you hear about this congressional race? We never talk federal politics, and I'm not opening that door here, but the Evan Lowe, Joe Simidian seat.
Yeah.
Okay. I just want to bring this up because my mind was just
where is it at?
exploding.
It was like a one vote last I saw.
Okay, so here's where it's at today. The official vote is finalized. So they have officially ended the count.
Okay.
And Joe Simidian and Evan Lowe tied at exactly 30,249 votes each.
Oh my God.
So
Are they each calling one of their cousins being like, how come you didn't vote?
So he actually says this in the article he's interviewed, and he said, I've heard from some friends that were like, man, I forgot to vote. I'm so sorry. I'm so sorry.
No
but
Christmas card this year.
Just like hammering in like every vote counts. But I don't know if this has ever happened. I'd have to ask a
Especially with that number of votes. Like you can see if it's a small town with 28 people, that might happen.
Yeah, exactly.
But what's the total votes that were cast?
So the top vote getter was Sam Liccardo. He's the former mayor of San Jose.
Yeah, did the pension reform over there.
Yes, yeah. And so he got the top number of votes, and then the second two. So he got more than 30,000, obviously. So I don't remember exactly, but it's combined. They're over 100,000 votes,
and they're exactly tied.
And so yeah, and then there was a bunch
statistical
of other
odds of that
too.
happening. Are,
oh my God!
Right?
It's like so. The really funny thing about it is nobody wants to do a recount.
Okay.
Right, because it could go either way, right? So both of the candidates that tied, they're not going to test fate and recount.
So they do flip a coin.
So under the law, and this is like crazy. So it's like under the California statute, if in the top two system, if the second two people tie, then they both go to the runoff. So you're going to have a 3-person runoff in that congressional district.
Oh, that's interesting.
Which, I mean, I'm bringing it up not because I have any stake in this race whatsoever, but just because my mind was blown.
That's just fascinating. Yeah, for the
How
political.
do you tie 30,000 votes?
This will be one for the political junkies. I'm sure Alex Vassar. That's a.
I'm sure he's running all that.
Yeah, he's like, has this ever happened before? We need to know.
We've had him on the podcast before. Maybe we'll have to have him back to talk about that. But yeah, so I just thought that was a crazy stat. But the last thing I wanted to ask you about, and then we'll get into it. So we'll play really quickly our clip of the week. So and you can comment as much or as little as you want to. But I'm going to play a clip of Senate Pro Tem McGuire on the budget deal that just got struck this last week. So basically, the majority party struck this deal with the governor on cutting about $17 billion in spending for the coming year. And so this is his comment, and then we'll talk briefly about the budget before we get into
the early actions.
The early action budget. Yeah. Yep. So let's play this clip.
When you have fiscal challenges at home, the family comes together to be able to reduce whatever that budget deficit may be, to be able to live within their means. And this is exactly what we're doing with the state of California. We have a budget deficit, just as we all would do at home. We need to be able to get our budget in line with our finances. And this is what's going to happen. There's going to be a 2-step process. Next week, we'll take an important floor vote in the Senate, reduce our deficit by $17.3 billion. Next step, we will be coming up with a spring budget plan. The Senate will be releasing ours in the coming weeks that will focus on closing the remainder of the deficit.
So, obviously, just to put this in a little bit of context, the legislative analyst came out this year, nonpartisan legislative analyst, pegged the deficit at about $73 billion.
Yeah.
The governor's initial number was below 40. Big discrepancy. This early action is obviously a $17 billion number, so not even coming close. I know the Assembly Speaker came out and said, I think agreed to this deal, but reiterated he does not want to spend all of our reserves this year on this one deficit. He wants to save,
which I think you can.
Some of them.
The Prop 2 rainy day fund requires you can only use up to half of it for any 1 year, I think.
Oh, okay. So I think the reserves are somewhere in the ballpark of 37 billion.
Yeah, I think that's all the
that's
reserves.
like combined.
Yeah, rainy day plus the
day.
supplemental reserves and others. Yeah.
So the proposal itself, it's 3.6 billion in reductions, 5.2 billion in borrowing, 3.1 billion in delays, 3.4 billion in fund shifts, and 2.1 billion in deferrals. That's a lot of the very small number in the reductions category, and a lot of dollars in the let's wait a year category or wait a few years category. So this is, I think will be a big, I expect this actually to come up for a vote in the Assembly and the Senate on Thursday. So it'll be a day after this episode comes out, but certainly has a kicking the can down the road feel to it, I think. And I'm allowed to editorialize, so
yes,
I get it.
You can. I won't.
But just you were a budget guy for a long time, and I know we talked with Roger Nilo last week about this. Certainly, you have to do some of this sometimes, but ultimately, $73 billion is a lot of money,
That's
right?
big.
So, and none of these legislators, and really to extent the governor, haven't really dealt with something like that.
No, that's
but
right.
you were around for some of the really bad budget years, so
Yeah,
how did you guys do it?
Well, the last one of the last ones I negotiated was the Great Recession budget, and I think proportionately it was actually higher as a percentage of the general fund because the general fund budget at that time was only around
It was a lot lower.
$80 billion
Yeah.
versus close to like $200 billion, I think
crazy,
it is
yeah.
now. So proportionately it was a lot more. And that was, at that time, it was pretty much a split of what I would say was there was tax increases, there was spending reductions, and then there was what we'll colloquially call gimmicks, but it was, the deferrals and the borrowing and that kind of stuff. But, I think certainly the message the pro tem's giving there about how families need to live within their means and the state does, it's obviously a good appropriate message for it. And it, at least in my experience, it's pretty much par for the course that the early actions tend to be the things that are less invasive, if you will.
Yeah.
And then there's always a desire to sort of see the May revised numbers because you don't want to take actions that you didn't need to take.
Sure.
Right.
Yeah.
So should things get better?
Yeah.
Which, I don't know what the over under on that is, but should things get better, you didn't want to have to take a bunch of negative actions and then go, sorry, listen, we don't need to do that. Right.
Yeah.
So you'd rather let's do the things that we sort of know we're going to have to do sooner or later anyway, get that done. And then we'll see what we really have left at this point. So it makes sense. I mean, strategically, it makes sense. I know this is always it's been, forever that the idea that typically the Republicans want to see more spending reductions sooner and earlier.
Yeah.
And you do get some additional benefit if you do more spending reductions earlier. You start to accumulate that benefit.
Sure. Yeah.
But on the flip side, there is that concern, more so from Democrats of we don't want to unnecessarily start to ratchet back programs and things that we care about, only to find out it wasn't necessary and could you avoid doing that. Yeah. So
I think that might have been part of the governor's mentality in January when he came out with his number because it's like, well, on the off chance that things get better, right?
Yeah.
But at the same time, it's, the ledge analyst is certainly a little bit looking at it with a slightly less biased lens.
It's interesting, and again, a part of me is hesitant to way too much into it since it's not what I'm involved in every day anymore. But I was thinking about it, and it had always historically seemed that the Department of Finance was much more conservative with their numbers. In other words, they typically had a bigger problem. They typically, would err on the side of revenue shortfall being higher.
Mm.
And it would usually be the ledge analyst that would sort of give a little bit more optimism.
Interesting.
They would sort of tell the legislature, well, spending might not come in as high as the governor's projecting, or revenues could come in higher.
Yeah.
So this to me was the first time I could think of where you really had the legislative analyst having a more conservative or pessimistic view of the budget problem than the governor and the Department of Finance. So
Interesting.
that was something that struck me as
that is actually
I don't really recall that being the case.
Huh.
So
well, I think at the end of the day, these are just the beginning of the discussions, I'm sure, because to your point, I mean, this is kind of the stuff on the top, right? And then we're gonna have to really dive a little deeper in the next few weeks. And this not having a 2/3 budget kind of cuts both ways, right? In a good budget year, it's nice because you don't have to bother with the other party's priorities.
Yep.
But in a bad budget year, you kind of own the problem.
Right.
So, I really think it's going to be interesting to see what is prioritized and what is not.
Yeah. And I'm sure you guys will be interested to see if there's more interest in your involvement or not.
Yeah, yeah, exactly. So we'll see what happens, but more to come on that. Let's talk about insurance, because I know this is going to be a big year for just potential insurance legislation, potential action at the state level. Given your current role and your experience, why don't we just start with something simple like, what is insurance? I mean, this is like a really dumb question, but like kind of insurance 101. How does insurance work mechanically?
Yeah. Well, obviously, there's a lot of different ways to interpret that. I think the simplest thing to think about is insurance is really just a mechanism for spreading risk, right? And you take your individual risk, you spread that among a community, among a county, among the state, and then among, frankly, the nation, and ultimately globally.
Yeah.
Right. As it keeps moving out, you have even insurers then have what are called reinsurers that they spread risk to, and so it's really, in a way, become a fascinating ecosystem that I would kind of always joke, at least when I was growing up, I remember my parents' age, it was always sort of the, things you don't talk about at dinner parties, and insurance will put people to sleep, and don't talk about politics. And I guess we'll be violating both of those today. But so, yeah, it's sort of been actually quite interesting to understand the role that insurance plays in our society. If you think about every house, every car, every boat, every business, building, any enterprise that's gone on has been underpinned by insurance. And a nerdy insurance factoid that I've learned since I've been in this role, certainly some of the earliest historical evidence of insurance goes all the way back like 4,000 years to the Code of Hammurabi, where they talk about early insurance contracts. And a lot of that was sort of around shipping and what would happen if an act of God came and took out a shipping, a load of goods and merchandise. And there was danger for merchants back then, because if your stuff didn't make it to the other side, they might execute your family. And so they would have to have like certain insurance so that didn't happen. So it's been around for thousands and thousands of years. And now obviously it's more sophisticated. Earlier forms of life insurance even started to happen in the 1300s, where they have these benevolent societies that would get together to, fund burial expenses,
like pull resources.
So it's really there's an insurance, but in modern insurance, it's really this mechanism to spread risk. Yeah, and it allows if in personal insurance, which is what we're involved in, deals with death or injury or property damage. That then you're covered for that, right? And liability. And I did a panel for a symposium on wildfire last week with a lot of sort of first responders, and talked a bit about how, they suppress the fire, prevent fire, suppress fire, put it out. But after it's all done, it's really the insurers that come in and fund the rebuilding of the community. Or on an individual basis, if you wreck your car, then it's
fix your car.
Fix or repair or replace that car. Yeah. So it's Yeah, it's more interesting than people give it credit for. I'll say that.
I know, yeah, absolutely. And, you know, it's also something that is often feared as someone with a almost 16-year-old who's about to start driving. I'm very terrified of insurance too. But,
Right.
But you talk about assessing risk, right? Like
my daughter, 17, just got her license. I want to say back in November, and yeah, it was a little.
it's a little punch in the gut.
Well, a nerve. Yes, you worry about them driving, and then you also will be. You'll have to start a little savings account for the hit on your because
when risk is higher, so are the premiums.
Well, they weren't wrong. She wasn't about 3 months until there was a ding.
There was a ding. I know, man. It's just like it's inevitable. So in California, what role within that ecosystem does the insurance commissioner play in all of this?
Well, yeah, the insurance commissioner in California has a pivotal role. I mean, started with this initiative back in 1988 called Proposition 103 that voters approved. I think it's fair to say that initiative was it proposed a 20% rate cut on your auto insurance. So everyone was like, yeah, that sounds great. So that passed, but in that it set up for an elected insurance commissioner.
Got it.
and a sort of a prior approval process for rates and a fairly unique to California system that involves something called interveners that we may or may not get into in this discussion. But so having this elective insurance commissioner, and it really moved a lot of the power and authority over insurance to this insurance commissioner, which is interesting for you and your colleagues in the legislature, right? Because really you have broad authority over so many things. And I think that's been a challenge with this issue is it's a lot harder for the legislature to establish its role in the discussion because so much of the power and authority sits with the insurance commissioner and the Department of Insurance and subject to the statutory initiative. And it's a 2/3 vote in furtherance of the initiative if you want to do anything. And so the commissioner plays a very important and unique role in insurance in California.
So within that, I mean, that is, you said 2/3 vote requirement. So obviously,
and in furtherance too. So it's not like you can just change what you want. You have to say 2/3 vote, and somehow
of the initiative,
it makes the goals of this initiative stronger too. So that's
so it is very limiting.
Yes.
in terms of like your options.
Right.
So and so I will ask you about that, but like before we get to kind of what the legislature is looking at this year, what are some of the biggest challenges that are facing, insurance in California that are, obviously impacting the market as a whole and impacting consumers? Because, when you have, I think I mentioned earlier, these non-renewals and you have insurers leaving the state, obviously reduces competition. It makes, so there's a lot of challenges there.
Yes. Yeah. No, it's we are, I want to say there's about 300 some odd thousand on what's called the FAIR Plan, which is the insurer of last resort in California. If you can't get insurance in the regular market, people go there. And at the end of the day, that's less than probably 4% of the overall market is on the FAIR Plan. Okay. But as one legislator said, and I take it to heart because I think it's a fair comment, was it's a 96% of the people are still in the admitted market, but for the 4% who are on the FAIR Plan, it's a crisis, certainly for them. And I think we're all starting to see it spread from these high fire risk areas into even more moderate risk areas and rental properties and HOAs. And so you can see this crisis really hitting sort of a crisis levels. And there's just a ton of things that all seem to be coming together, at the same time. I mean, we talked a little bit about this initiative that put the power with the department, and over the decades since 1988, a host of previous insurance commissioners implemented a lot of regulations that sort of guide how insurers do business in California, guide and or limit what things they can do. And so there's these regulatory I want to say there's rules there that were not set up for the current state that we find ourselves in.
Got it.
Right. So, for example, you'll see one of the big conversations right now is around the use of catastrophe models, forward-looking models that allow you to sort of introduce how will climate change and risk of drought and people's population movements into high fire risk areas contribute to the probability of risk and losses. And the current system is based on just a historic look back. You can only look at what happened 20 years ago. And looking 20 years backwards is not a good guide of what's before us, right? And so that's like one of the example of one of the regulatory barriers. But maybe that wouldn't be such a problem if we didn't find ourselves in this era of, sort of this mix of climate change and drought, where you have, again, hundreds of millions of dead and dying trees, and then we have
dry conditions,
right? And you see even the housing and housing affordability issues driving people further out from sort of the coastal and urban areas. So now they're moving into these less expensive, more rural, or what we call WUI, wildland urban interface areas. So they're moving into areas that traditionally burned, but didn't have a lot of houses. So you had wildfire, right, for millennium in California. But there weren't thousands of houses there.
There weren't people living there.
Right. Even some of these big fires that we talk about with the Paradise Fire and the Tubbs Fire in Sonoma, they've happened before, almost in the exact same footprint, but there just wasn't a lot of homes or people there. And so you have this combination of sort of this outdated regulatory structure. You have the sort of changing of fire season that has connections to climate change, climate-driven risk. That is clearly, I have this little chart I've been using in some of my presentations. I know folks can't see it, but it talks about 8 of the 10 most costly wildfires on the planet have happened in California. And that's happened since, other than one in 1991, most all of that has happened in the last 6-7 years.
Wow.
So that's historic changes in the risk of wildfire, right? And fires with $10-12 billion of losses, which had never happened in history. And so that's happening. And then the little cherry on top, if you will, was sort of this hyperinflation scenario that happened coming out of COVID, right? Where everyone felt it, right? We saw the prices, obviously, of used cars were up 40%. We saw eggs spike to $8 a dozen. Gas was up at $7. But then for insurers, for example, when you look at the cost to rebuild a home, labor and materials went up 35% in 2 years. So if you think about that, even if you didn't have any of this wildfire risk, you would still have a 35% increase in your exposure risk just because the cost of rebuilding the homes went up that much. Layer the catastrophic wildfire on it, layer on sort of the housing affordability population movements into higher risk areas on that, bring in a host of regs that were sort of developed in the late 80s before we had, smartphones and the internet, and they're not responsive or conducive to these changing conditions. They worked okay when things were static, but they don't work well when things are dynamic and changing. And we've got a real recipe for an insurance crisis, in California. So,
and I know we've talked about this too, like what is it called? Telematics? Is that?
Oh, yes.
I know this is for cars specifically, right? Where like some states I feel like have gone to this model where you can opt in or something to some sort of, and I know Tesla does this and stuff, but some sort of tracking of your driver activity.
Yeah,
right?
I think most cars can do it, and certainly even your phone can do it.
But we don't allow that in California yet.
Right, that's right. That's another thing that is, prohibited in California. You'll see the ads, driving based on your risk, your personal risk, available everywhere except here. And then you read the fine print. It's like not in California. And it's the same thing, honestly, too, with those CAT models. I think every 49 other states allow the use of catastrophe models for forward-looking, projections. There's an issue around what we call reinsurance. I talked a little about how reinsurance is insurance for insurers, and spreading that risk across the globe. And it's a real ingredient in the cost of doing business. But in California, it's another thing that, going way back in the regulations, is just there was a sort of a decision to say, nope, you can't include the cost of reinsurance in your rates. And so as the cost of reinsurance has climbed dramatically over the last 5 years due to all the global catastrophes, it gets very expensive. But in California, you can't put that in your rates. If I can't buy reinsurance, I can't spread my risk. If I can't spread my risk, I really can't take on more policies.
Wow.
And thus you can see how people start to then say, I need to non-renew or freeze my business, because you can't grow your risk-based capital for taking on more business. So you've got a couple of examples, again, of these regulations unique to California, where every other state allows the net cost of reinsurance. Every other state allows the use of catastrophe models.
Forward,
I'm not sure what it is for I believe most every other state, if not all, allow the use of telematics. And there's a lot of good reasons. I think there's discussions around telematics where you look at even some of the social justice stuff, right? If disadvantaged communities and certain groups are being more targeted by police, or more neighborhoods are being targeted by police, and then that gets on your DMV record. Well, that's what you use today when looking at auto insurance, whether you're a good driver or not, you look at your DMV record. But if you just had a purely personal risk-based, doesn't care where you live.
There's no bias in that, right? Yeah.
I don't believe there's any bias in that, right?
Or
It's
at least in theory,
that at least that we're aware of.
Yeah.
And so,
also,
you think it makes sense for a lot of reasons, but
it just seems like a more accurate representation of your personal risk versus relying on certain metrics. Like, that could be indicators. Like, I could theoretically be a great driver, but maybe I'm not.
Right.
Like, so
but
maybe I've been lucky.
Right. But if you're speeding a bunch and you're doing hard starts and hard stops and speeding, then, the telematics will show that. But if you're just a good driver, then it'll show that, and your rates would be based accordingly. So there's some discussion around that. Not a whole lot with the Department of Insurance, but I think some of your colleagues are starting to.
I think there's interest for sure, at least to give consumers the option. Right. As prices continue to go up, why wouldn't you want the option?
Right. Well, certainly. Right. If you can opt in or not, right?
Yeah.
If
hey, I'm just going to drive real slow.
I got a heavy foot here. I think I'm not going to opt into that.
Yeah, exactly. Which may be some people.
Right. It might be some people in this room. Who knows?
We don't know. So last question, and then we'll get you out of here because I want to respect your time. But what do you kind of see this year in the legislature? Like, what do you think are some of the changes that probably need to happen? Obviously, it sounds like we've already talked about some of them. Like, we need to increase this flexibility in some of the regs.
Right.
But what is actually being discussed? What do you think is going to come together this year, and what can the legislature do in that process?
Yeah, that's interesting. I'll say there was a pretty big effort several years ago in 2020, I want to say, with then Assembly Insurance Committee Chair Tom Daly and current Senate Insurance Committee Chair Susan Rubio. And they had a two-bill package that really got at a set of reforms. Would have been a 2/3 vote bill. Received great bipartisan support. I believe it got out of the Assembly like 64-4.
Wow.
And out of Senate Insurance Committee 11-0, and then got stopped in Senate Appropriations right near the end. And that had a host of sort of solutions. And we were supportive of that bill. PIF was, and most of the insurance industry was supportive of it. But that didn't happen. And then there was sort of this idea that there's so much of this that really is under the aegis of the insurance commissioner and the department. And so the legislature and even I think the governor were sort of like, you guys need to talk and go figure this out a bit. And that took a couple of years of back and forth that sort of culminated last year and then a session. Obviously things started to peak last year, as you noted, in May, when sort of State Farm announced they were in a position where they had to freeze all new business in California. And then it came out that Allstate had done that a year earlier, and other companies had been sort of quiet quitting. And so that then led to some much more intense discussions, with the legislature, the key leadership and committee folks, the industry, the governor's office, obviously the Department of Insurance.
Yeah.
And sort of out of that was born the governor's executive order. And then the commissioner in September sort of announced his sustainable insurance strategy that is really bringing in forward a lot of these, dealing with a lot of these sort of antiquated regulatory issues. How can we get insurers to come back to the market, get a more competitive, healthy, stable insurance market in California? Let's bring in these modern tools, catastrophe models, allowing the net cost of reinsurance, as long as you can demonstrate that it reflects the California specific risks. Frankly, looking at the FAIR Plan, how do we reduce the FAIR Plan's growth and create some more financial stability there as an element? And in return, the expectation, a requirement, if you will, that in order to use these new tools, insurers are going to have to demonstrate that they're increasing availability in sort of insurance distressed areas.
Got it.
Right.
Okay.
And depopulate the FAIR Plan. A little bit of you're going to have the opportunity to use these new tools, but there's a condition that you have to show that you're going to actually grow your business in the state, come back and grow your business in the state. And so that's been, there's a set, actually this month, there's going to be a workshop on the catastrophe model proposed regulations on how that's going to operate. Certainly we anticipate soon seeing reinsurance proposal and some FAIR Plan operational changes as well. And then that package of things will lead to insurers being able to then submit a filing where they're going to say, here's what we think we need to have our rates actuarially reflect the risks. And with that, we'll be able to take on additional risk in these areas. And that'll all be in a filing that goes to the department that the department can review, and they can ultimately say yes or no to. So they'll always retain that power. And so really that then goes, well, at that point, then what does the legislature do? So what we've been seeing a lot from certainly the Senate and Assembly Insurance Committees is a deep desire to exercise the sort of oversight and transparency of this process, right? Exercise that role. Since so much of the control by under 103 is set over here. But hey, insurance commissioner, come in, tell us how it's going.
Tell us what's going on.
Let's hear let's hear from all the affected groups, whether it's, what we sort of view as true consumer groups, which would include, people in HOAs, Farm Bureau, Apartment Association, builders, realtors, how are they being affected? How does these regulations look to you? Obviously the industry. So there's a lot of that sort of oversight and transparency happening in the legislature this year, and expectations, I think heavy expectations on the commissioner and his leadership team to deliver on this, which it's a lot, it's a big cultural change for the department to shift in how they think. So they've got a lot on their plate, but I think we're in a mode where the legislature is trying to make sure they're giving the commissioner the support and direction he needs to go get this done, and in a timely and an efficient way. And I think that's going to be the majority of the focus this year.
Well, we'll see how it all plays out. I think ultimately, the goal is, how do we create an environment where companies can participate and compete?
Right.
And because really, ultimately, that is what is best for consumers, right? Is the competition.
100%.
So,
right. I mean,
how can we create that environment again in California, where obviously companies can, spread out their risk appropriately, but also consumers have options, and not just the FAIR Plan or whatever.
That's the option you don't want, right?
Which is what you don't want.
Yeah. So, no, it's I sort of distill it down to, in many ways, it's an economics 101 problem. You have a willing seller and a willing buyer,
right?
And you just need to allow them to meet on what is a fair price for that risk,
right?
And have insurers be able to guard against their solvency risks, right?
Absolutely.
So that they can say, hey, I can take on this risk without fear of going insolvent and making sure that I can keep my promise to the consumer to pay that claim. And so that's obviously just as important as having the availability of insurance, as having insurance that actually is there when you need it.
Yeah.
So that is certainly the goal. And one of the simple lines, and we go out and meet with legislators a lot, and I have a colleague who always just says, we're in the business of selling insurance. This is what we're here to do. We don't want to be saying no and
we can't sell you this policy. Like Nobody wants it. Yeah, exactly.
Right.
Yeah,
These companies didn't spend decades and decades building a brand.
Yeah.
And and advertising and build. Everyone knows Limu, Emu, and Flow, and
of course.
Nationwide is on your side, right? All these, right? And they build that because they want you to call them and they want to sell their insurance to you.
Yeah.
And so something is wrong when they're saying
we're not going to sell.
Freezing business here. We can't do it. We just can't do it. And and I will say one of the frustrations certainly I have is there are some groups out there that try to push this message like this is some kind of game, or this is some kind of bluff. I heard I had a little Hoover Commission meeting last week, and it was, just so disappointing and irresponsible to hear that when it's, it's so clear. I mean, you see the AM Best ratings, taking insurers from stable to negative.
Right.
State Farm just got downgraded themselves. You can see what's happening with their risk-based capital pots just shrinking, losing billions of dollars. It's all public information. And people who put that out into the universe, it's just really a disservice to the idea that we've got to come together. We've got to have a collaborative process. And anyone who wants to be a responsible adult and be at the table and have suggestions on how we fix it, great, come be there.
Yeah.
But don't say that it's a game and everything's fine the way it is, because that clearly isn't
it's clearly not true. And honestly, that harms the ability for us to make progress on fixing it too. So
that's
like, hey, we got to fix the problem.
Yeah,
so hey, well, I think that's a perfect place to end. Seren, I really appreciate you coming on. This was a really fascinating topic. I think I learned a few things for sure.
Awesome.
Hopefully the listeners did. So
I like to hear insurance and fascinaation in the same sentence.
Hey, I find this stuff really interesting. That doesn't mean everyone will, but I mean, I definitely do. In the coming weeks, so actually a little announcement for next week. I introduced this audit of homelessness spending in California. That actually comes out tomorrow morning at 9 a.m. So we're recording this on a Monday. So next week I'll be breaking that down a little bit.
Is the audit coming out?
The audit results are coming out. The audit's coming out tomorrow.
Wow.
It was supposed to be out in December.
That's interesting. Isn't LA is having to do their own audit now?
In LA, we talked about that last week. So the federal judge is making LA, which is going to be very eye-opening. So lots of good information coming out. I'll break that down next week. If you want to share ideas for future shows, you can email pointoforderpod@gmail.com. You can follow us and subscribe across the board on YouTube, Twitter, Instagram, Facebook, Threads @pointoforderpod. If you would want to vote on that poll today on whether you should be able to ignore your boss, go to X @pointoforderpod, and you can follow me on Twitter, X @Joshua_Hoover. Seren, thanks again so much. I really appreciate it.
Yeah, thank you for having me. This was fun. My first podcast. So I enjoyed it.
You did great, too.
Yeah,
so.
thanks.
All right, well, maybe we'll have you on again. We'll see you next time.
That'd be great. I'd love to come back.
All right, see you later.